If you're saving for something in the short term, like an emergency fund, a vacation, or even a house down payment, where should you actually put the money? A lot of investors get this wrong. They focus on trying to grow the money when the real goal is to protect it. Today, I'm going to walk you through a simple framework to decide exactly where your short-term money should go. Let's start with what we mean by a short-term goal. So this includes things like your emergency fund, saving for a vacation, buying a house, starting a business, or any large expense coming up in the next few years. Now, here's the key idea. Short-term investing is not about maximizing returns. It's about protecting your timeline. Because if your money drops right when you need it, that's a problem. So there are three different categories that I typically like to put short-term capital. And I'm going to show you a few of the examples here. I'm going to pull up my screen. You can see here that I'm at a ticker called Cash. It's an ETF. And essentially what this is it's a high interest savings account. So think of it like if you are somebody who has over $1 million in the bank and you look at those interest rates that the banks will give you, they usually give you a really high interest rate for someone like that. But if you only have like a couple $1,000s or even 100,000, sometimes even just $100,000, they're not going to consider you to be somebody that they're going to give that really premium rate. And so what ends up happening is you end up having a really smaller return. But if you get into something like an ETF where you're getting into something like this Cash here, you can actually take advantage of having those higher rates. And so the way that's done is it's actually pooled assets, it's pooled money. So think of it like if you had a bank account and that was set up and that was specifically for, everybody together. That's essentially, in practice, is kind of what's going on here. And the best way to look at it is if you actually look at what kinds of holdings this has here. You can see here that 49.5% is coming from National Bank cash account. We can see Scotiabank cash account 28.48%. So we've got CIBC, right? So it's all the banks. Basically, what you're doing is you're taking advantage of that high interest savings account. And the reason why this is something that's actually a good option is because there's a lot of flexibility. There's a lot of liquidity here. As well, there's an American version. So in Canada, we don't use bills as much as they do down in the States. We usually, I see a lot of people that are investing in these, what I call them is HISA accounts, high interest savings accounts, HISA. But in the States, they're usually getting into T-bills and just short-term T-bills. One of the most popular tickers, let me show you here, is actually Bill. And it's 1 to 3 month T-bills. So essentially what they're doing is they are buying T-bills and they're buying them at different intervals. And so then, they'll buy one and then, when those ones come to expire, they'll buy another one. And so it really just keeps that duration between 3 to 1 month. And what that does is it avoids there ever being a real high fluctuation up and down in regards to if there's an adjustment to the interest rates and such. And so what that does is it provides a form of consistency in yield, just like how that high interest savings account ETF works. So those are some really good options. I find when people are looking at trying to get into something that they want to be really fully liquid, they want to be able to get in, they don't want to have any negative or any downward risk. So in a lot of ways, that's just very low risk. You obviously have to factor in the fact that, you're relying on the government and in Canada, you're relying on, the big banks, which is a lot different, the banking system in Canada than the States. We're a lot more regulated that way. So the risk is probably not as high as if it was down in the States. As well, it's very simple, right? Interesting way to kind of do it is, if you have an account, A lot of people, they'll have just like a savings account at their bank. Again, a high interest savings account that I'm referring to here is not at a bank, it's an ETF that I'm referring to. But the easiest way is if you have an investment account that's set up and you basically are buying those types of investments into that account, and that's simply the same thing as holding it within a bank account, or just an alternative to doing that. Again, not financial advice. Consider these at your own risk. Everybody has a different risk tolerance. Again, these are all extremely low risk, but it's something that you definitely have to evaluate. And the other thing to factor in is that there are lower returns, and as a result of having that lower risk. And the benefit though is you're not going to have interest rates change. You're not going to have any of that confusion or anything like that. Now, let's talk about, if, let's say, for example, you're saving up specifically for a house, that you're going to be purchasing that house in exactly 2 years, or, you're saving up for a vehicle, exactly how much money that vehicle is going to cost, exactly when you're going to purchase it. In those types of situations are a lot different, I feel, than having something like an emergency fund, or when you get to a certain financial threshold, then you're gonna that's when you're going to take the money out, or you need to use that money at a moment's notice. That's where something like I just reviewed is actually the best option. But when you know your time frames, using something different can be beneficial. So for example, like a GIC or a CD, those tend to be pretty good in those kinds of situations. The reason for it is because in a lot of cases they're locked in. They have less flexibility. They do have a guaranteed return to them, which is really nice. They're insured. And they're usually higher than short-term bonds or HISA accounts. So let me just give you an example of that here on my screen. So with Questrade, for example, this is who I'm with. Whoa, I gotta zoom back in here. We can see here that there are various types of products that you can get here. So you can see here that there's different durations. So you can see, if you looked at like a 1 year, 2 year, 3 year, 4 year, 5 year, typically you would find that as you lock it in for longer term, you tend to have a higher rate. Again, it doesn't always work exactly like that, but in most cases, that's usually the situation. So the GICs are very beneficial in that way. Again, CDs are kind of like the same thing. You can also go to your bank and talk to them. They usually have different types of GICs and CDs. But if you go with a brokerage account, at least you can have a look at various types of options and kind of see what best suits you. So if you really know your time frames, when it comes to wanting to have those guaranteed returns, you want to have a little bit of a lift in regards to the percentage that you're going to make back on that money that you're locking up, then maybe a GIC or a CD might be beneficial. So, the goal here is, it's not about growth, it's about certainty. And, you want to choose your strategy based on when you need the money and how flexible you need to be. So if you found this helpful, I break down more investing strategies like this inside my community and on this channel.